Well, hello there. So this second video is, or the second practice problem set for money and loanable funds is about loanable funds. So it's kind of a continuation of the previous one that we actually did before with loanable funds number one, where it's like a drop in credit card fees gives people blah, 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 right? So we actually established some of this already. So if you have page 12, it can be helpful if you wanted to look at it. It says, given the interest rate change, because there's less demand for money, what will happen to the price level in the short run? And that year, that AP exam question came out, it really confused students because they had to kind of figure out the interest rate change, number one, and then they had to make a lot of kind of connections to get there. So if you have your problem from number one, if there's a demand for money decrease, we'd say, therefore, interest rates should decrease, right? We know that. And therefore, we'd say consumption and investment should go up because they're interest sensitive. And so therefore, aggregate demand rises, therefore price levels rise. And so that's the chain of thinking that kind of they were hoping you could get to on the AP test. So basically connecting kind of this to the outcomes, right? And other outcomes that you might be asked about would be unemployment, and that would go down because outputs, aggregate demand's higher, or they could just ask about output, and that's higher as well. So kind of thinking about like the end goal is a stable economy. You want to make sure that you've got, GDP, unemployment, and inflation. That's the end goal. That's what we've been studying this whole semester. Unit 6 at the very beginning was GDP, unemployment, and inflation. So how would this stuff affect those three factors is really where we're getting to. Now, the second part is related to the question as well that you studied before, where it says, in country Z, the required reserve ratio, blah, 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 right? So it says they sell 50 million in bonds. What's the impact of that on the equilibrium price level? So, we'd say if they sell bonds, what does that do? And again, we're going to use basically the same logic chain, but think about what does it do to the money market, or what does it do to the loanable funds market? We'd say here, the supply of money decreases, so interest rates go up, therefore consumption and investment fall, therefore AD falls. Oops, I've got to put a down arrow. Therefore AD falls. And what is it asking for price levels in this one? So we'd say price levels would go down. So again, everything basically after this point, after this link in the chain, is all review from Unit 7. So if you need some practice with that, I would encourage you to go back and take some of those practice quizzes because it's linking chains of thought together. That's the tough part. It says, as a result of the price level change, are people with fixed incomes better, worse, or unaffected? Explain. And this is one where, we've seen that question on basically every test is, how are real wages affected when price levels change? So we've got here, if price levels go down, we'd say, therefore, real wages go up because of their, because people are sticky wages, right? We have fixed incomes, and so the real value of your wage would rise. And that's actually a perfect explanation, is you're just saying, here's why the real wage would go up, right? So we'd say, therefore, better off, right? Then it says, suppose the economy is at full employment, right? So this is a different problem. It says the central bank buys bonds. I don't know why they would do that if they're at full employment. We don't care. Draw a graph of the money market showing the short run change, okay? QM, and this is one where it's kind of nice to see all of the different pieces at once, right? So you've got Q star and I star is where we start. But if they buy bonds, the money supply gets bigger, right? Money supply gets bigger. So we would shift this curve to the right over Q1, and it pushes the interest rate down as well. So we have more money in the system and the interest rate's lower. And it says draw a graph of the loanable funds market showing the short run change, okay? So quantity of loanable funds. And now over here, real interest rate, right? That's the difference. We still have downward sloping loanable funds demand, but now we have an upward sloping supply of loanable funds. Again, students often make the mistake because they really don't have a clear conceptual difference between these two markets. This one is for all the money, and the Fed controls that money supply exclusively. This one is for the money that's being borrowed, and the lenders, the supply here, are the people who are saving money, and they're saving more money in response to higher real interest rates. So we've got a starting position, Q star and IR star. And if the Fed, right, if the supply of money gets bigger, we can say the supply of loanable funds increases. It's kind of almost a not kind of a duh that this would happen, but there's literally more money that banks can lend out, right? That's the whole point of the activity. So there's more of a supply of loanable funds, increase, and so Q1, right? And IR1. And then so we see the real interest rate falls and the interest rates fall. Now it's going to say ADAS. Oops, I almost wrote quantity. So it's just Y, or you could say GDPR, right? Some of you are doing that. That's fine. And we start in equilibrium, and it tells us that at the beginning of this problem. So we go LRAS, YF, and if we're in equilibrium, then it's crossing right on that full employment level of output. So aggregate demand, short run aggregate supply, and a given level of prices, right? So now what's going to happen if the real interest rate falls, right? If the interest rate goes down, we'd say, therefore, aggregate demand will go up. At this point, we should be getting pretty good at seeing those shifters. So we could push aggregate demand out, and we could push price levels up. All right, so that kind of shows you some of the relationships between all of these different activities and how that could work. If you had an economy in a recession, right? If we started in a recession, all of this could still work, and you might actually be able to shift aggregate demand to fix the recession. So hopefully this helped you. See you next time.